Hey, everybody, John Duncan here. I get the question a lot. We do a lot of leveraged life insurance planning for uh, top earning professionals, business owners. And the question always comes up, well, why would a bank want to lend in many cases, millions of dollars to fund a life insurance contract? And what's in it for them? Well, the banks make money lending money. They have to lend money to make money, if you will. And insurance, life insurance, and I'm talking specifically about permanent life insurance, is an asset, just like things like real estate, would be considered an asset. Life insurance is an asset, and permanent insurance is very unique. If you were to compare it to like real estate, say you had a $1 million piece of real estate that you were going to take a loan on, um, you know, you're going to have to put a down payment. Let's say it's rental properties. So you put, let's say 30% down. So you're putting 300,000 down. And, the bank is betting that A, you're going to be able to make the payments, and B, that the property will at least maintain value or hopefully increase in value. But it could actually decrease in value. And you could be in a position where you couldn't pay the payment, and then there'd be a whole foreclosure process. It's a long drawn out, could be very expensive. The bank could actually lose money on that transaction. When it comes to insurance, there's a million ways to structure these type of accounts, but in general, there typically isn't down payment like there is on a house. And the insurance itself, the life insurance, is protecting the bank if you were to die, untimely demise, or and also a lot of times it's structured one of two ways. One is to protect a large estate to pay the estate taxes, and two would be to create a cash account that could create tax advantaged income in retirement. And in that case, you're basically trying to get as much cash as the IRS will allow into that account. So the bank is funding it up to the very maximum amount of cash value that can be in there. And the results are pretty amazing. But in that case, either in the beginning, depending on how we design it, or in a very near future, the cash value itself is supporting the loan. So say somebody had a $10 million life insurance cash, or $10 million loan goes into a high cash value account. And after say 5, 6, 7 years or less, again, there's a million ways to design them, but the cash value, let's say, has grown to 11 million, 15 million. It's higher than the loan amount. And in that case, it's a cash on cash transaction. In other words, it's better than real estate when you look at it from that perspective, because it's protected if you died. Depending on your state, there's also provisions for terminal illness, things like that, where the bank could be paid at that point as well. And finally, the cash value is basically making the bank whole all the time. So that's why we are able to get very attractive interest rates on these type of transactions. Another question that comes up, obviously the bank just wants to make interest and they want safe loans, and that accomplishes both of those. Why would a person use lender funded insurance instead of paying premiums themselves? Well, a lot of times they don't have the kind of available funds to just fund for insurance for large scale, large levels. And I mean, available because they've got it invested somewhere else. So it frees up cash to invest in other opportunities by letting the bank finance most or all of the purchase of the insurance. And this is these type of programs, they're complex and they have to be handled by professionals. This is not something that you just uh, get involved with people that have never done them before. And in my experience, the larger the case size, the more is needed expert level, not only on the lending side, but also on the insurance side, because just getting these placed can be a challenge if you have not done them before. But when they are all put together, there's significant tax advantage, just similar to real estate. And the bank has got a super secure loan on the books that's usually substantial size. So it's just a great advanced planning uh, program that, in the country, there's, I can count on one to two hands groups that do these regularly at a large scale. And if you've got somebody, that's great. If you don't, basically, I'm always, putting together cases like this, as well as finding the best of the best out there as far as insurance company practitioners and lenders, so that we can get really shopped rates that are as good as it gets. And it's all in the design in these type of programs so that they run as efficient as possible. So with that, I'm going to run. Again, the reason that banks put money into insurance contracts at large levels is they view insurance, permanent insurance, as an asset, and a super secure asset at that. So with that, thank you very much. Again, John Duncan. If you have any questions, reach out to me. Otherwise, I'll talk to you soon. Bye-bye.